Today I want to analyze Meituan. It's a Chinese company and their main business is food delivery, but they also offer hotel and travel booking. We can take a look at the stock price and we see we are up around 56% in a 1-year chart, and in the 5-year chart we are up 64%, but from the high in 2021 we are down around 61%. So we're going to take a look at the financials to find out if this company is undervalued right now. The first thing we can recognize is a huge market capitalization of 124.2 billion US dollar. This would make Meituan the 12th largest company in the internet space by the market capitalization. We also can see we don't have a dividend yield. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So we can see here in 2020, the revenue was around 114 billion Chinese yuan. This was an 18% increase from 2019. Then we had a 56% increase in 2021. Then a 22% increase in 2022. Then a 25% in 2023, and then around 22% in 2024. So overall, we have a great growth in the last 5 years. So it's a check here. The next thing we're looking for is free cash flow growth in the last 5 years. Free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So we can see here in 2020, the free cash flow was around 7 billion in the negative. Then in 2021, around 13 billion in the negative. Then in 2022, it was positive, around 5.6 billion Chinese yuan. Then we had the 492% growth in 2023, and then again around 70% growth in 2024. So this is a really good growth in the last 5 years. We can see we come from negative to positive free cash flow. This is a great number, so let's check here. We can actually see here in 2020, the operating cash flow was already positive, but we can also see here the capital expenditure was very high in 2020 of around 15.8 billion Chinese yuan. Then we had the capital expenditure decreasing to 9 billion Chinese yuan, decreasing again to 5.7 billion Chinese yuan. So overall, I think this is the reason why the business gets more free cash flow now, because the capital expenditure decreased over the years. The next thing we're looking for is a free cash flow yield over 4%. This can also be an indication for the valuation of this company. If the free cash flow yield is under 4%, it can indicate an overvaluation. So what we're going to do now, we're going to get the free cash flow from 2024, so around 57 billion Chinese yuan. Then we're going to divide it with the current market capitalization of 901.3 billion Chinese yuan. So the number we get is around 6.34%. So this is over 4%, so it's a check here, and we like to see that this can be an indication for undervaluation right now. The next thing we're looking for is debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. A very important number, because if the company has too much debt and cannot repay the debt, it can risk to go bankrupt. So what we're going to do now, we're going to take a look at the long-term debt. We can see here around 39 billion Chinese yuan. Then we're going to add the short-term debt as well. So the short-term debt is around 16.5 billion Chinese yuan. Then we're going to divide it with the current free cash flow. This was around 57 billion Chinese yuan. So the number we get is around 0.97. So this is a good number. In a little bit under 1 year, we can repay the debt with the free cash flow. So it's a check here as well. We can also take a look at the cash on hand. So how much money this company has in the bank. And we can see here around 168 billion Chinese yuan. This is a great number as well. We can already repay the debt with this money and invest in the business. So it's a good number and a good balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. This can also tell us about the valuation of this company. So the lower the number gets, the higher the indication for undervaluation. So first we're going to calculate the enterprise valuation. This is the market cap. So we're going to take the 901 billion Chinese yuan. Then we're going to add the debt. So the debt is a long-term debt plus a short-term debt. So this is around 55 88.5 billion Chinese yuan. And then we're going to take minus the cash that we had, so 168. This is the enterprise valuation. So the enterprise valuation is around 788.5. So then we're going to divide it with the current free cash flow. So the current free cash flow is around 57 billion Chinese yuan. So then we're going to get the number of around 13.79. So this is a great number. It's an indication for undervaluation because it's under 25 and it's a check here. So we like to see that. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially if we think the company is undervalued. So we can take a look here and we see many years in a row the shares outstanding did increase. So this means the company put more shares on the stock market. But now in 2024, we see the shares outstanding decreased around 3%. So this means the company buys back their own shares. And we like to see that, so the check here. I would like to give my conclusion about this company. So let's start with a positive. So we had a strong revenue growth in the last 5 years. We also had a strong free cash flow growth. We have a free cash flow yield around 6.34%, which is also looking good. It's an indication for undervaluation. We also have the enterprise valuation to free cash flow ratio around 13.79. This is also an indication for undervaluation. The company also has a great balance sheet, which means a low amount of debt and a good amount of cash on hand. So overall, I think this company looks undervalued, and I think this company has a lot of potential, especially if this company can continue to grow the free cash flow in the future. If you found this video helpful, don't forget to like and comment and subscribe for more content.